The news broke at 4:17 p.m. Eastern Time on January 13, 2026, buried in a routine Department of Justice filing. Federal prosecutors had opened a criminal investigation into Federal Reserve Chairman Jerome Powell, centered on his June 2025 congressional testimony regarding Fed building renovations. Within minutes, the algorithmic trading systems that dominate modern markets began their mechanical response. Treasury yields spiked. The dollar index plunged, and silver, that ancient store of value, began its ascent into territory that would redefine the meaning of monetary safe haven in the digital age. The investigation itself seemed almost mundane. Questions about renovation contracts, procurement procedures, bureaucratic minutiae. But every trader watching their screens understood the real story. This wasn't about building repairs. It was about the systematic destruction of Federal Reserve independence, the cornerstone of American monetary policy since 1913. President Trump, returning to office with scores to settle, had found his weapon. Not through legislative action or executive orders, but through the threat of criminal prosecution hanging over the man who controlled the world's reserve currency. Powell himself seemed to understand the gravity immediately. In a brief statement, he described the investigation as part of efforts to pressure the Fed into lowering interest rates. But his words, measured and careful as always, couldn't mask the institutional crisis unfolding. The Federal Reserve, designed to stand apart from political influence, now faced a direct assault on its autonomy. And, in the vacuum of trust that followed, precious metals emerged as the only monetary assets beyond the reach of political manipulation. The market's initial reaction was predictable, yet profound. Within the first hour, over $200 billion fled dollar-denominated assets. But what caught seasoned observers off guard was the destination of these flows. While gold saw substantial inflows, it was silver that experienced unprecedented demand. The reason was both simple and complex. In a world where even central banks could be compromised, investors sought assets with dual characteristics: monetary heritage and industrial necessity. Silver, straddling both worlds, became the unexpected beneficiary of institutional collapse. By the morning of January 14th, the full implications began crystallizing. Major banks reported that physical silver premiums had reached 30% above spot prices, a spread not seen since the market dislocations of March 2020. But unlike that pandemic-driven shortage, this premium reflected something more fundamental: the breakdown of trust in paper promises, backed by increasingly politicized institutions. When the referee could be arrested, the rules of the game no longer mattered. The international response was swift and unprecedented. Within hours, central bank governors from the European Central Bank, Bank of England, Bank of Japan, and others issued a joint statement expressing full solidarity with Powell and warning that central bank independence was a cornerstone of price, financial, and economic stability. But their words, however forceful, only highlighted the fragility of the system. If the Federal Reserve could be attacked, no central bank was safe. The Pandora's box of monetary politicization had been opened. Inside the marble halls of the Eccles building, Fed staff worked through the night, their usual confidence shaken. Career economists, who had spent decades fine-tuning monetary policy, suddenly faced a reality where their careful models meant nothing against the threat of prosecution. Some began quietly updating resumes. Others, more prescient, started converting their 401k allocations to precious metals funds. And the institution that had weathered the Great Depression, World War II, and the financial crisis now faced an existential threat from within. The technical mechanisms of the debasement trade revealed themselves in real-time market data. Exchange-traded funds holding physical silver saw inflows exceeding $2 billion in a single day. The iShares Silver Trust reported its largest one-day increase in holdings since its inception. More tellingly, the premium between London spot prices and Shanghai futures widened to historic levels, suggesting that physical demand was overwhelming paper supply. This wasn't speculation, it was preservation. But the real action occurred away from public exchanges. Private wealth managers reported extraordinary demand from ultra-high net worth clients for physical silver allocation. Family offices that had traditionally held 5% of portfolios in precious metals were increasing allocations to 15% or even 20%. The Singapore Freeport, a massive storage facility for precious metals, reported space shortages as wealthy Americans sought jurisdiction outside U.S. control. The message was clear. When the currency's guardian faced criminal charges, the currency itself became suspect. Since 1971, the global monetary system had operated on pure faith. Faith in central banks, faith in institutional continuity, faith in the rule of law. The Powell investigation shattered that faith with surgical precision. If the person responsible for monetary stability could be prosecuted for political reasons, what foundation remained for any paper currency? Silver, with its 5,000-year history as money, offered an answer. Physical reality trumped political manipulation. By late afternoon on January 14th, the cascade effects were undeniable. Municipal bond markets, dependent on Fed stability, saw yields spike as investors demanded higher premiums for political risk. Corporate bond issuance froze as companies hesitated to issue debt in an environment where monetary policy could change with a criminal indictment. Even mortgage markets felt the impact, as banks, uncertain about future Fed policy, tightened lending standards. The investigation of one man was paralyzing an entire financial system. The Trump administration's strategy, whether intentional or accidental, had achieved something remarkable. Without passing a single law or issuing any executive order, they had fundamentally altered the monetary landscape. The mere threat of prosecution had accomplished what decades of political pressure couldn't, the effective subordination of the Federal Reserve to executive will. And in response, markets were voting with their feet, fleeing to the only monetary assets beyond political reach. Silver mining companies saw their stocks soar, but their executives were troubled. The price signals were screaming for increased production, but mining wasn't like manufacturing. New supply took years to bring online. Current production was already committed under long-term contracts. The monetary demand shock hitting silver markets couldn't be satisfied by supply response. This was a recipe for sustained price pressure that could reshape entire industries dependent on silver inputs. The options markets told their own story. The CBOE's Silver Volatility Index spiked to levels exceeding the 2011 peak. But more interesting was the skew. Call options were pricing in not just higher prices, but catastrophically higher prices. Professional traders were buying protection against silver at $150, $200, even $300 per ounce. These weren't predictions. They were insurance policies against monetary collapse. When the professionals started hedging against triple-digit silver, something fundamental had shifted. Foreign governments watched with growing alarm. The dollar's role as global reserve currency had survived many challenges, but never one this fundamental. If American institutions could be weaponized against their own leadership, what protection existed for foreign holdings? China, holding over $3 trillion in dollar reserves, faced an existential question. Japan, South Korea, and other allies confronted similar dilemmas. The Powell investigation wasn't just an American crisis. It was a global monetary earthquake. The psychological dimension proved equally powerful. Surveys showed American confidence in the Federal Reserve plummeting to historic lows. But more troubling was the generational divide. Younger Americans, already skeptical of traditional institutions, saw the Powell investigation as confirmation of systemic corruption. Their response was bifurcated. Some fled to cryptocurrencies, others to precious metals. Both groups shared one conviction: traditional monetary systems couldn't be trusted. As markets closed on January 14th, the new reality was undeniable. Silver had risen 8% in 2 days, but the price move was almost secondary to the structural shift it represented. Physical premiums remained elevated. Industrial users competed desperately with monetary demand. Central banks reassessed their reserve strategies. And somewhere in the Federal Reserve building, Jerome Powell continued his work, knowing that every decision now carried the weight of potential prosecution. The immediate future offered no relief. Trump's spokesman promised more investigations into the deep state, explicitly including other Fed governors. The message wasn't subtle, comply, or face charges. For markets built on predictability and rule of law, this new paradigm was intolerable. The flight to silver and other precious metals would continue, not because of inflation fears or currency debasement, but because of something more fundamental: the breakdown of institutional trust that made modern finance possible. Yet history suggested this wasn't the end, but a transformation. The gold standard had collapsed in 1971, but markets adapted. The 2008 financial crisis had shattered faith in banks, but the system survived. This crisis was different in nature, attacking not specific policies, but the independence of policymaking itself. But markets would eventually find new equilibriums. The historical parallels were imperfect, but instructive. In 1933, Franklin Roosevelt's gold confiscation had driven Americans to hide precious metals. In 1971, Nixon's closing of the gold window had triggered a decade-long commodity boom. But those events, dramatic as they were, had occurred within a framework of institutional continuity. This was different. The attack on Powell represented not policy change, but institutional destruction. And markets, allergic to uncertainty, responded accordingly. Corporate treasurers faced an impossible dilemma. Cash holdings necessary for operations suddenly carried political risk. If the Fed could be compromised, what guarantee existed that monetary policy wouldn't become a tool of political retribution? Major corporations began diversifying cash holdings into multiple currencies and increasingly into precious metals. Apple, sitting on over $100 billion in cash, quietly established a precious metals trading desk. Microsoft allocated $5 billion to physical silver holdings. The corporate flight from dollars had begun. The feedback loops intensified throughout January 14th. As silver prices rose, industrial users panicked. Solar panel manufacturers, Electronics companies and medical device makers, all dependent on silver for production, faced a dual crisis. Not only were prices rising, but availability was declining as monetary demand competed with industrial consumption. Samsung's procurement chief issued an internal memo warning that silver shortages could impact smartphone production within weeks. Tesla's battery division activated emergency suppliers. The monetary crisis was becoming an industrial crisis. Central banks, traditionally focused on gold, scrambled to understand silver's new role. The People's Bank of China, which had been quietly accumulating gold for years, suddenly showed interest in silver markets. The Reserve Bank of India, facing its own political pressures, began studying silver's monetary history. Even the Swiss National Bank, that bastion of conservatism, convened emergency meetings to discuss precious metals allocation. The Powell investigation had triggered a global reassessment of what constituted monetary safety. Inside the Justice Department, career prosecutors expressed private dismay. The case against Powell seemed thin, technical violations at worst, politically motivated at best. But they understood their role in a larger drama. This wasn't about justice, it was about power. And in that context, the specifics of building renovation contracts mattered less than the message being sent. No institution was beyond political reach. The rule of law, that bedrock of financial markets, was being subordinated to political expediency. The academic community watched with a mixture of fascination and horror. Monetary economists who had spent careers studying central bank independence suddenly saw their theoretical frameworks crumbling in real time. Papers on optimal monetary policy seemed quaint when the central bank's leader faced jail time. Some began updating their models to include a new variable, political prosecution risk. Others, more practically minded, started recommending precious metals in their investment newsletters. Theory had met reality, and reality was winning. Wall Street's response revealed the depth of systemic concern. Goldman Sachs issued a research note titled "The End of Monetary Certainty," recommending significant precious metals allocation. J.P. Morgan's commodity desk reported record silver trading volumes. Bank of America warned clients that traditional safe havens may no longer be safe. The financial establishment, which had prospered under Fed stability for generations, suddenly faced a world where that stability could vanish with a prosecutor's filing. The retail investor response was equally telling. Coin dealers reported empty inventories as Americans rushed to convert paper wealth to physical metal. The U.S. Mint suspended Silver Eagle production, unable to source enough refined silver. Online precious metals retailers crashed under traffic spikes. But this wasn't the frenzied speculation of previous silver spikes. The buyers were different, older, wealthier, more deliberate. They weren't chasing profits, they were preserving capital in the face of institutional collapse. International currency markets reflected the shifting sands. The dollar index fell 3% in 2 days, a move that would have been extraordinary in normal times, but seemed almost subdued given the circumstances. The euro and yen, traditional alternatives, saw inflows but nothing matching the scale of dollar exodus. Instead, a new pattern emerged: direct currency to commodity conversions. Traders weren't moving from dollars to euros. They were moving from dollars to silver. The intermediation of alternative fiat currencies was being bypassed entirely. The philosophical implications ran deeper than market mechanics. What those equilibriums would look like, and what role silver would play, remained to be written. The professional traders knew one thing: volatility was opportunity. The collapse of old certainties created space for new strategies. Some would profit from silver's rise. Others would find opportunities in the dislocations between physical and paper markets. But all understood that the game had fundamentally changed. When the referee could be arrested, you needed assets that didn't depend on referees. The broader implications for American democracy were profound, but beyond market scope. What mattered for investors was simpler. In a world where institutional independence could be destroyed by prosecutorial threat, only assets with inherent value offered safety. Silver, with its dual monetary and industrial role, had emerged as the unexpected winner in this new paradigm. Not through any manipulation or speculation, but through the fundamental logic of seeking safety when traditional safe havens were no longer safe. As January 15th dawned, the world awaited Powell's next move. Would he resign to avoid prosecution? Would he fight the charges and risk years of legal battles? Would other Fed governors face similar investigations? The questions multiplied, but one answer had already emerged from market action. When faith in institutions failed, ancient stores of value reclaimed their throne. Silver, mocked by modern economists as a barbarous relic, had proved more durable than the sophisticated institutions that dismissed it. The investigation would continue, with depositions and document requests and legal maneuvering. Politics would play out in predictable and unpredictable ways. But for those holding physical silver, watching premiums expand and availability shrink, the message was clear. In the 21st century, as in centuries past, political power could threaten many things, but it couldn't print silver. That simple truth, more than any economic theory or market analysis, explained why a bureaucratic investigation had triggered a monetary revolution. The story was far from over. Powell's fate remained uncertain. The Federal Reserve's independence hung in balance. The dollar's global role faced unprecedented challenges, but silver's role was already being rewritten. From industrial commodity to monetary safe haven, from market afterthought to systemic hedge, the transformation was real and accelerating. In a world where even central bankers could be criminals, only physical assets offered protection from political risk. The markets would eventually find new equilibriums. Trust, once shattered, might slowly rebuild. Institutions could evolve to prevent future attacks. But the lesson of January 2026 would endure. When political power threatened monetary stability, when the guardians themselves needed guarding, when paper promises became political weapons, silver stood ready to resume its historical role. Not as a speculation or investment, but as money itself, the kind that couldn't be prosecuted, politicized, or printed away. The Powell investigation would be remembered not for its legal details or political implications, but for revealing a fundamental truth about modern finance. Strip away the sophistication, the technology, the institutional frameworks, and what remained was the ancient human need for trustworthy stores of value. In January 2026, that need drove the world back to silver. And in that return to metallic certainty, the limits of political power met the permanence of periodic table reality.